Moment. But first, let's talk Pinterest. This is the mover of the day. The shares are plunging as its user base declined. The company reported just over 450 million monthly active users in the second quarter. That was 30 million short of estimates and a 5% drop from Q1. They're saying usage dropped as people returned to socializing in person. We've been hearing it across the board this week. Facebook fell shy of estimates for monthly users. Twitter missed daily user forecasts, and Pinterest shares are down more than 18% today. Matt Maley, one of the topics we've been debating here for some time this year is whether the FANG trade is over. What does this week tell you?
Well, it definitely is a concern. I mean, it's funny because I've never been a huge a fan of Pinterest, but a lot of people have been. But the thing is, a lot of these stocks that had been dead money for a while, but a lot of tech stocks, but like Facebook broke out, Apple broke out, even Microsoft, they all broke out. But Pinterest, Pinterest has been dead money continually since February. And it's kind of been in this downward sloping trend channel, and this just takes it right back down to the lower end of that. And my concern is that on a technical basis, you break below 55.50, it's lows from the spring, people are just going to throw in the towel and start dumping the stock. So I'd be very careful about buying this one on weakness.
Although, Joanna, this is one of those, the stocks are going to, they're going to overly, what am I trying to say? They're going to go up too much on the way up. They'll probably come down too much on the way down. But it was interesting to look beneath the hood here. Pinterest is actually making a lot more money on the users it does have, $1.32 versus the $1.17 estimate. So, it's introducing new ways to kind of buy things now. If it ultimately comes out of this as making more money for the users it does have, isn't that in the interest of investors in the long run?
Yeah, well, first I was hoping that Matt was going to promote his knitting Pinterest board, so I'll have to come back to the show for that next time. But I think what we're seeing across the board was it was unsustainable for any of these services or social media companies to keep that level of active user time, right? We had a lot of time during the pandemic. It went toward these services, and now we're going to pull back that time. And so as you bring up, Kelly, I think there's an interesting product perspective of how, when you're on the product, what are you doing there then? And is there a way that the company either gets you to spend more time there or spend more money or engage more with advertising or whatever it may be the business model? But the idea that we're going to now, come back at any point really to that kind of pandemic time engagement and active user time, we're seeing it across at Twitter, Pinterest, Amazon. That's just not realistic.
And Mike, it was interesting, and we'll have more on this next hour, but Morgan Stanley does a survey of its interns every summer to try to figure out what the kids, order and use and do and all this stuff. And in the case of social media, Pinterest had like 1% of people, interns responding and say they had anything to do with it. So again, we all know this is not like Snapchat, but if it's popular with the, dare I suggest, boomer crowd, those of us millennials, whoever it is, us old people who have a little bit more disposable income, is that still, a decent business model in the long run?
It could be a decent business model. It's a matter of how big the actual company is going to be. It's still more than a $35 billion market cap. It's got a little bit of a Twitter issue where intense engagement among those who use it, but only a minority of people use it. It's not a universal app necessarily. The other piece of it is we've seen this separation between social media that is compatible with finding stuff to do out in the real world, like Snap and Google, and those that are much more about just, eyeball time on the screen while you're killing time for doing other things. And also, finally, Pinterest might have a link to a cooling off of the housing market. The home renovation trend probably peaked early part of this year. Yeah,
if that's the case, then everyone should be snapping up to attention what Pinterest shares are doing. So sort of pivoting to Amazon, let's stay on this theme and maybe broaden this out a little bit to talk about what's going on with growth stocks and FANG more broadly. Amazon shares have been having one of their worst days in quite some time. They had their first revenue miss in 3 years. They're warning of slowdowns ahead. The company is blaming slowing growth rates on consumers taking trips and going out versus online shopping and other lockdown behaviors. They reflected the last full quarter of Jeff Bezos' tenure as well. Shares are down less than 7% right now. So, Matt, put this one in kind of the broader context. There's overlap between the e-commerce names that did well during the pandemic and the FANG trade that has been dominating for a decade. Where is this pointing you next?
Well, there's no question this is a concern. If it had just been, for instance, if it had just been their margins that disappointed, we'll just say, well, this is just, Amazon once again investing in their own business, and so they're cutting back on their profits. But when the revenues come down, that's a concern, especially when you have these new, situation coming down. The people are talking about peak growth, peak earnings. Is that going to be a problem? I will say, though, however, just people need to realize that this is really an overshoot on the downside for technical reasons. And the reason is that the stock had broken out of this sideways range it had been in for 10 months. So a lot of momentum money went piling into the stock the last couple of weeks. Now that it's fallen back into that sideways range, a bunch of that fast money momentum players have just dumped the stock. So it's still a great long-term company, a great long-term play, and a little bit the outsized move today, I think, has to do with that than their real results.
Joanna, what would you add about Amazon's performance?
I mean, this is another situation, too, where I'm interested to see, well, we've got holiday, we've got a lot of other spending times coming up, right? So looking forward, it seems like, okay, this is probably not that big of a hit. But I'm also really looking to see these companies. I mean, this is a moment for them, I think, to innovate, again, on product and thinking about, okay, during the pandemic, we saw these crazy levels. We saw these record highs. How are there places where we can squeeze that out? What did they learn from that? I mean, every time I talk to a tech executive right now, my biggest question is, what did you learn for the future from the pandemic? And I hear lots of, a lot of marketing talk, but I also hear some real product talk as well.
Mike, this might be totally a side note, but I think I've been an Amazon Prime member since 2005. And just the past couple weeks, we were looking at home to see, do we really need to be Amazon Prime members? And, it's just an interesting exercise. It was sort of like, well, we just paid for the yearly membership. So, yeah, I guess we'll, but we don't really watch a lot of the videos. And anyhow, this question for you is more about the trade. Like I was asking Matt Maley about, where is the FANG trade going from here?
Well, I mean, I do think that if you want to look at the way Amazon, Facebook, Apple, Microsoft reacted in a negative way to what are generally on objectively pretty good results, it's only dialed you back a week or a month in terms of, where these stock prices were before. So we're taking back some of this last little burst of upside. I do think that they're losing a little bit of specialness, or at least when it comes to just, how much they can grow year over year, this sense that they, need to grow into the premium valuations they've had. That's fair. When it comes to Amazon, what's interesting is if you talk to an investor that loves the Amazon investment thesis, it's about AWS, cloud services. It's about Prime, which is just a stickiness, of the subscription model, and even advertising as a growth vector. Those three things were fine in the latest quarter. And so the question is, if it can keep growing at 20% top line, which it did this time, it probably is okay here longer term, even if it comes off the boil a little bit in terms of, excitement level.
Very well said. I mean, those kind of growth rates are still scarce. A quick question to both you and Matt here about Robinhood. We did learn that Cathy Wood was buying up about 1.3 million shares for her Ark Innovation ETF. So even though it had a rough debut yesterday, it's snapping back up today. And she's on the record saying, Mike, that Ark Innovation includes her highest conviction names. Why do you think she sees value here for Robinhood?
I think it's just by the disruptor. Now, the big question is not whether Robinhood is a major disruptor to retail trading and investment services. It is, has the disruption already mostly happened? And, just what's the value of the loyalty of the new coming investor base that they've collected here. And it's a big head start. Tons of small accounts, as we discussed. So it's very consistent, I think, with the ARK approach in general, which is, buy the disruptive name in the fast-growing market and worry about the profitability sometime later.
Exactly. Matt, a quick word on this one?
Yeah, I just think the IPO wasn't priced correctly, so don't worry about the immediate reaction of the stock right now. I guess my point is, Mr. Wonderful was on CNBC this morning talking about they're here to stay. Robinhood is here to stay. I agree. I guess my point is build a position over a period of time, over several months, and we'll give it some time to find its true value because it's going to take a little bit of time.
Shepard Smith here. Thanks for watching CNBC on YouTube.